What if I tell you there's one simple ratio that can instantly tell you whether a company is financially risky or rock solid? A ratio that every smart investor checks before putting their money into any stock, and you should too. Well, that ratio is called debt to equity ratio or DE ratio. So what exactly is the debt to equity ratio? How do you calculate it? And what does it reveal about a company's financial health? Well, I will simplify it for you in this episode of Finance Now, where we make finance easy for you. Think of DE ratio like checking how much loan burden a person has, just like how you would be worried if you have 5 lakh rupees in loans but only 1 lakh rupees in hand. The simple formula to calculate debt to equity ratio is total debt divided by shareholder equity. Here's how to interpret it. Generally, a debt to equity ratio below 0.5 means low risk, conservative company. 0.5 to 1.5 means balanced and generally healthy. About 1.5 means high debt, higher risk company. Let's take a quick example. Company A has 50 crore rupees debt and 200 crore rupees equity, which means it has a 0.25 debt to equity, which is safe. Company B has 300 crore rupees debt and 100 crore rupees equity, which means it has a debt to equity ratio of 3, which means it is risky. But here's the catch. There's no universal good ratio. Remember, a higher ratio means more debt, while a lower ratio indicates a financially stable company with a lower reliance on borrowed funds. The debt to equity ratio is your financial health meter for any company. It helps you spot risky investments before it's too late. So do you also check that debt to equity ratio before investing in any stock? Share your thoughts with us in the comment section below.